Are you a long-term investor? You putting your money in a company long-term. You want to continue to see that stock price appreciate. You want to have a nice retirement nest egg for you to retire off of. That's cool. However, let's talk about some of the things that the market may do to fool long-term investors around their long-term investments. And what you're going to see and what you've currently seen over the past few months and what you're going to probably see going into the next year is you're going to see what we call a lot of stock price manipulation. And what do I mean by that? The CEOs of these companies, these boards are going to try to figure out a way is how can we manipulate the stock price by manipulating the public's perception of the actual value of the shares. And the reason why they need to do that is because in a lot of situations, there's not going to be legitimate earnings there. And what do I mean by that is that many people believe that we're going into what we call an earnings recession, where the earnings of a lot of companies are going to be suppressed. They're going to be diminished from a year-to-year standpoint, from a quarter-to-quarter standpoint over the year-to-year. However, they want to still maintain public perception of the value of those particular shares, and they want to make sure that people perceive that the value is greater than the current stock price. And then what they're going to do is they're going to roll out a lot of psychological ploys to get people to believe this, and many people will fall victim to it or fall into it is because their psychology already has been proven to be malleable by these particular CEOs, by these boards of directors, and also by mainstream media. What we're going to talk about in this video is two items that we believe that are going to be used against long-term investors and something that they should look out for and ask themselves, am I getting caught in the hype of this particular situation? And the reason why you're at this particular channel is because we often talk about the things that the average financial channels don't talk about, because we try to make sure you get the meat and potatoes, not the sizzle. We try to make sure we give you the steak. So let's go ahead and get into it. And the reason why, or what makes us different from other financial channels is we try to give you the meat and potatoes around the issue. We just don't try to give you the refined white flour with the high fructose corn syrup mixed together and baked in the oven, right? So we're not trying to give you the pastry. We're trying to make sure you get the meat and potatoes. So let's get right to it, right? And the first thing you want to look for coming out is what we call stock buybacks. And stock buybacks is when the company buys back shares of their own stock. And here's a really quick definition from Investopedia. Stock buyback occurs when the issuing company pays shareholders the market value per share and then reabsorbs that portion of its ownership that was previously distributed amongst public and private investors. When the company repurchases its shares, it can purchase the stock on the open market or from its shareholders directly. In recent decades, share buybacks have overtaken dividends as the preferred way to return cash to shareholders. Though smaller companies may choose to exercise buybacks, blue chip companies are much more likely to do so because of the cost involved. And one of the things that we forecasted was going to happen this year, but we also forecast it will continue to happen as we roll into next year, is a lot of the CEOs, board of directors of these publicly owned companies are going to try to raise public perception and manipulate the psychology of their shareholders, but also of the overall market, the financial-based media, by saying that we're going to engage in a stock buyback. Now, let's get back to the slide because I think this is a little bit more attractive than just looking at Investopedia. What I want to ask you is this. If I tell, let's say I have a private company, right? And I have 5 other shareholders in my private company. And I come out and I say, hey, we're going to do the annual report. I say, hey, we're doing really good this year. We have $500 million in cash in the bank. And what I will do is I will buy 10% of the shares back from my 5 other shareholders. So every other of my 5 other shareholders that own stock in my particular company, or our company, I should be saying, I will buy back 10% of your shares. Now that brings cash right back to them. But this is the question they should be asking. David, with you being CEO of this particular deal that we're in, how come you're not using that $500 million or using a portion of that $500 million to do investment in technology that can drive more sales, make our business more competitive, to do R&D research to make our business more competitive, to down the line drive more sales and create new products, create new services, to reinforce our supply chains, our manufacturing capability? How come that money's not being invested back into the business to make the business more competitive which means that we can serve our customers at a higher level. We can serve more customers, which means therefore that will raise the stock price. Why? Because the earnings become greater, right? Makes our business more efficient. Let's work on getting with our engineers and trying to figure out how to make our manufacturing processes more efficient. We'll get with our supply chain people, how to really tighten up our supply chain so our operating margin starts to go down. Therefore, our profits start to go up and people perceive our particular company as being more valuable. Therefore, they go in to buy the stock at whatever price. And then therefore, that raises the value of my investment in this deal. Why would you buy the shares back? Right? And these are the questions you should ask. So when we're looking at a stock buyback, whether it's a privately owned company or a publicly owned company, my question would be, why is the cash being used to buy back stocks and not being used to invest in the business? Because let's say we're looking at a publicly owned company. The company goes back into the overall market, because it goes back into the equity market, and it says we'll buy shares from the overall market. So the concept is that we're going to pay shareholders for the stock that they currently own. But once I sell it back to the company, then I no longer own the stock. So how did it benefit me? I can still get out of my position through the overall equities market. I don't need the company to buy my stock for me. Because if the company is going to be the only buyer, or let's say the company and the market maker are the buyers of last resort for my stock, I'm already in trouble. If I'm in a publicly owned company, the market, the overall equities market, should buy my stock based on what they believe the fair value of that stock is at that moment when I get ready to sell it that day. So essentially it will be a day trade. If I'm the owner of the stock, so let's say company XYZ, I own 100 shares, right? I own 100 shares and the company says we're going to do buybacks. And I say, well, you know what? I'm willing to sell 20% of my position. The company never says, so let's say I'm in company XYZ, I own 100 shares and the current value of that stock, let's say it closed that day at $100 a share. The company never says we're going to do company buybacks and we're going to pay out $140 a share. The company does a buyback at the actual price of that stock at the moment they go into the market to buy shares. And they're going to get with their broker and they're going to essentially buy stock over. So they'll say, we'll do X amount of buyback over the next 12 months. They're not going to do the buyback that day. So let's say we're going to do a $100 million buyback. It doesn't mean they do it all in one day. We're going to do a $100 million buyback over the course of 12 months, which means what's the best price that we can buy this stock back from the shareholders, but really the overall market over the next 12 months. So they may wait for a 10% dip in the share price. Then they'll go in there and they'll buy it. You understand what I'm telling you? This is what people need to understand about the stock buyback mechanism. It's a great psychological ploy because what does it sound like? Well, first, the company's going to buy shares. Two, it's going to decrease the amount of shares available to the public. So what does it do? It skews the earnings per share now. It's been skewed because now we have less shares and we have the same earnings or higher earnings. The earnings per share looks higher. But it's only because it's a stock buyback. It's not because our actual earnings are greater. It's because there's less shares available in the market. But the biggest question you would have as a long-term investor is how come you're not investing this money into making the company more competitive, a better company, making it be able to compete at a higher level in our market, making sure that we can lead the market. So what can we do to be the number one and number two company in our particular market? How come we're not investing in those things as opposed to buying the stock back? But it's a great psychological ploy. Next thing you got to worry about. Wouldn't say worry, but you want to be concerned with if you're a long-term investor. Are we taking on debt to do this buyback? Right? If we're taking on debt to do this buyback, what does it mean? We now have to pay it back. But like I said, we're taking on debt not to increase manufacturing, increase engineering around being a lot more efficient business, increasing our supply chain management, doing R&D. We're not taking out a loan to even do marketing. We're taking out a loan to buy back stock, which means what? We now have to buy the stock back. We now have to pay the loan back. We're taking on debt to buy back stock, which means now we got to pay the debt back. How does that help us as a company? And that's what I want you to understand. If you're a long-term investor, so I'm not going to say if you are. If I'm a long-term investor, these are the kind of questions I would have. But it sounds good because what happens? Financial media hypes it up, right? The internet hypes it up, but it doesn't change anything about the company. Except now we're taking cash out of this company or we're taking on debt to buy back stock, which does no improvement in the company. So if you look at Avis, right? Avis EPS is like 14. It's just ridiculous. Why? Because they bought all their shares back, but they still owe $21 billion in debt. Right? They still own $21 billion in debt. Eventually, they're going to have to pay that debt off, or they're going to have to push that debt down the road, which means they still have to pay it off. And they're doing stock buybacks. They bought back literally, I think, over $1 billion of stock over the past few years of Avis. Some people know it as a ticker symbol CAR. Well, what have they done to improve the technology around that particular company? What have we done to make it easier for people to rent cars from us? What have we done to, engineer our company to be a lot more efficient? What have we done to create a process or to create efficiencies in our business to lower our operating margin or operating expense, right? What have we done in these particular areas? Nothing. We're just buying back stock. And therefore, if you're in that deal, yeah, they'll pay you money for your stock now. So I guess if you bought in at 30 and they're willing to buy it back from you at 150, it's a good deal if you're willing to sell out. If you want to sell now, makes sense. I guess it does. However, if you're a long-term holder in this deal, if you don't want to sell for the next 20 years, how does it help you? And these are the things that you want to ask yourself about stock buyback. So we're going to continue to see, especially if we go into an earnings recession into 2023, you're going to see a lot more companies talking about, well, we're going to do a stock buyback. Why don't we use that money and improve the company? Right? Why don't we? But it becomes hyped up to where people think it means something. Then what it means is that, well, they're going to buy the stock back from the shareholders. Well, then why would I buy in now? Why would I wait till the buyback is over and then buy in if a stock buyback is going to create demand? So let's say I'm outside looking in of this deal. I'm not a long-term investor, but I'm thinking about it. And they say, well, we're going to do stock buybacks. Well, to me, this is the worst time to buy. Why? Because I know the market's going to perceive it as being a bullish sign, which means they're going to buy it up, which means now the stock has become more expensive. I want to wait till the hype and the hysteria is over, and then I want to buy in. I don't want to buy in where everybody's trying to buy. Right? I don't want to ride the bull run. I want to buy into a company that I'm confident about their long-term forecast when the market is flat or bearish. I don't want to buy in when everybody's buying in because it's a long-term hold. It's not a trade. Okay, let's talk about the next one, which is going to be stock splits. Now, we've seen this happen multiple times with companies like Tesla. They like on their 12th split, and that's an exaggeration, but they split a lot over the past 4 years. Apple split during the pandemic. I think didn't Amazon a lot of people split. Why did they split? We needed to create a psychological way to get people back invested in this deal. Right? Splits don't change anything about the company. So let's go to the Investopedia explanation of a stock split. Stock split happens when a company increases the number of its shares to boost the stock's liquidity. Although the number of shares outstanding increased by a specific multiple, the total value of all shares outstanding remains the same because a split does not fundamentally change the company's value. The most common split ratios are 2-for-1 and 3-for-1. That means for every share held before the split, each stockholder will have 2 or 3 shares respectively after the split. Now, one reason why people will tell you that stock splits take place is because they can make the shares less expensive, therefore more people can get in. Okay? Let's say a stock's trading at around $1,000. Most people cannot afford $1,000 stock. What we can do is we can increase liquidity on this particular stock. Let's do a 3-to-1 stock split. So what each share becomes now what? $300 something. We can get more people in this deal. A lot of people would tell you that Tesla did their stock split, their first stock split, is because they needed to decrease a lot of their volatility before they got into the S&P. Because if you look at the S&P 500, there's not a lot of really volatile tickers there, especially the ones that are weighted over 5%. There's not a lot of really volatile tickers there. And there was a rumor that the S&P wanted Tesla to become a lot less volatile So they needed to split because they used to be I remember I was trading Tesla when they had like 70 million shares. That stock was a monster. It was a monster. It'll run you over so fast you wouldn't know what happened to you. Because they were so volatile, because there were not a lot of shares, and then you had SoftBank in Japan gamma squeezing the stock with options plays. Like that thing was a monster. That stock was like Bo Jackson in 1989. Like it'll just run you over. It doesn't matter what side, the bearish side, the bullish side. If you catch the wrong side of that trade, man, you will get run over extremely fast. But what they did was they kept splitting it, which increased more liquidity, which made the stock not trade the way it previously did, 2019, 2020. And so now we're dealing with the after effects of that. Then they split, I believe they split again, if I'm not incorrect. We've seen a lot of tickers split over the last 6 months. Why? Because they have to try to figure out a way to keep people psychologically invested in this deal. Now, when they split, from my understanding, is that your equity position stays the same because the market cap stays the same, because the price is just adjusted. However, what you have to understand is that this is done and it's seen by a lot of people, especially over the past 2 years, as being a bullish move. But it really shouldn't be a bullish move because it doesn't increase the value of the company. And it doesn't increase your equity position, even though you have more shares, right? But the market perceives it as bullish, or we're getting ready to split. We saw when GameStop split, they said, well, that was going to explode the stock because the short sellers were going to have to pay the dividend. They split, it didn't change it. But the CEO, Cohen, he did a split. Why? Because he understood that we're in a market where people psychologically see a split as a bullish move. They split GameStop and nothing happened. Why? Because that was false, what they were saying, that it was going to split and all the shorts going to have to pay the dividend. That was false. But we have to create this bullish narrative around the split because I got to keep my YouTube career going. Now that hasn't happened, those guys have turned into I don't know, inspirational speakers or whatever in the stock market space, but that's a whole nother conversation. I want you to understand that when you're a long-term holder, or if I was a long-term holder of a stock, I would not get caught in the hype around stock buybacks because I'm concerned why we're not using the capital to improve the business. I want this business to improve. I want this to be the leading player in our space. Why are we not? You telling me the board and the CEO don't have the creative minds to come up with a better use of capital than to buy in our stock? Because a stock buyback is a short-term solution, right? So let's go back here. A stock buyback is a short-term solution. It's a short-term way to raise the stock price. It has done nothing to improve the business. If I was a long-term buy and hold investor and I'm looking at a stock split, right? It can create a bullish sentiment around the stock. It's not a solution it doesn't improve the actual operations of the business. Does it? It can create a bullish sentiment because more people now can buy in because it's less expensive. The actual business that I've invested in has not improved. Where's the improvement? Is it an R&D improvement? Is it an operational improvement? Is it a managerial improvement? Is it a supply chain improvement? Is it a value chain improvement? From an operational standpoint, what about the business has improved? But when you ask these questions, or when I ask these questions, these are questions for more of a savvy investor as opposed to somebody that's just caught up in the hype. But the financial media, the financial marketplace is about getting people to be caught up in the hype. At the end of the day, when you're investing in a company, you're investing in a business, right? The shares are a representation of equity ownership in the business. But at the end of the day, it's still a business. Now, can the market have the wrong story around a business? Yeah, you have some businesses that I believe are undervalued. Therefore, their stock price is suffering, even though they have a very, very strong business. And you also have vice versa. You have businesses that I believe are overvalued, even though they don't have the business case there, but they're very much overvalued, like GameStop and AMC was. Very much overvalued in comparison to the actual business that they had. This is how you really start to look at things, in my opinion, right? Or this is how I would start to look at things from a long-term investor standpoint. What is the business, right? What is the actual business that they're involved in? Not what the hype is, not what's the hottest, what's the next Tesla. Don't care about what the next Tesla is. Just like I'm not looking for the next Michael Jordan, right? I don't need Steph to be the next Michael Jordan. Steph is Steph. Jordan is Jordan. I'm not looking for the next. What is going to be the business to where their share price at this current time is lower than what I believe their value would be in a 5 to 10 to 15 to 20 year period. All of these games they play are really designed to keep the public involved in it, to give the financial media something to talk about. It has nothing to do with the long-term value of the company, in my opinion. Not a financial advisor cannot give you financial advice. But many people that are created by this industry, they are participating in this narrative around these type of events. And in my opinion, if I was a long-term investor, I wouldn't care about it. Are they tradable? Definitely. They're definitely tradable. But from a long-term investment standpoint, they really don't have any impact on the ticker. In fact, in my opinion, stock splits hurt. I don't like Amazon stock splitting, but I think they did that for antitrust reasons, right? But I'm not a fan of Amazon stock splitting, but I think it was an antitrust reason why they split that stock, right? Talked about before, I think Tesla split because the S&P didn't want that really volatile ticker. They didn't want Tesla coming in at 70 million, 80 million shares. It was too volatile. It started moving the S&P. S&P got enough to worry about with Apple and Amazon. They don't want Tesla adding to their confusion. However, I would look at long-term business case. Now, if you don't want to do that, if I didn't want to do that, I would just buy the overall index. But this is one of the reasons why, in my opinion, people are bad at picking stocks. Even though I think we're going back into a stock pickers market. I think the 60-40 is dead. I think we're going back into a stock pickers market. Is because they have this desire to find the next hot thing, as opposed to finding companies that dominate their market in real life, not on the internet. Actually, what I mean by that is that not somebody saying it does, but it actually does through their financials, right? Dominates their market through their financials. And the share price is lower than what the value will be based on a person's analysis next 10 to 15 to 20 years. But we understand, especially from a lot of the conversations on YouTube, people have a bad time understanding what an investment is. And they have this psychological desire to want to hit everything out of the park. So what they look to do is try to grab a home run while the home run's coming out of the park. And so that's why they jump on and they get caught up with the buybacks and the stock splits, as opposed to realizing that when you're building out an active portfolio, every ticker don't have to be a winner. It's called portfolio management. Every ticker on the S&P 500 is not a winner either, but people still invest in the overall index. When you're building out an active portfolio, my opinion, like I said, so if I'm building out an active portfolio, let me restate that. If I'm building out an active portfolio, every ticker does not have to be a winner, right? Because I understand rotation, I understand balance, I understand management, I understand allocation, I understand these things. I'm not just driven by, I'm trying to find the Tesla of the vegan quick serve space, which is supposed to be Tattoo Chef. Company that's probably going to go bankrupt this year. When I can accept that, the companies that may lead my portfolio may be the most boring companies in the world, but they're the companies to where their current share price is lower than what I think their perceived value is going to be. And I may not get a big appreciation in share value, but I may get a gradual appreciation in share value. So that they may return 7-8% year, but it could be year in, year out, year in, year out. And I'm not chasing a 300% return. I think that's the issue. But we know that a lot, especially on YouTube, a lot of people don't understand the concept of an investment, right? They're either trying to catch a baseball that's going out of the park with their hand. And what I mean by that is that somebody hits a baseball to hit a home run, and this person's trying to jump up off the ground and catch it and ride it out of the park. Next to impossible. They're trying to jump into a car window of a car that's going down the road at 40 miles an hour. Next to impossible. You're going to hit the car, you're going to fall to the ground. as opposed to figuring out how can I, or what I would try to do is figure out if I was going to do active investment, how can I portfolio management to where my winners outpace my losers? And I think that's why most people don't work at stock picking, right? And they don't want to do the trial and error, because a lot of times you have to what I had to learn is I have to unlearn or unprogram myself from a lot of the lies that the financial media has taught me. And then once I understood how to do that, then I started to see, well, where's the real value at? And a lot of times the real value is in stuff that's not what I've been programmed to believe is sexy. If you look at Coca-Cola, you look at PepsiCo, their earnings is really well. They're selling an addictive product. Most addictive products do well regardless of the financial situation. Why? Because it's an addictive product. We know that caffeine is addictive. It's an actual drug. And we know that sugar is addictive. Sugar acts as a drug inside people's bodies because it gives you a dopamine hit. What does PepsiCo and Coca-Cola sell? They sell a drug, and they got a license to sell it. It's legal. They sell that drug worldwide. They worldwide drug dealers. We're in a recession. Price went up. People still bought that drug. Why? Because people are going to chase that high. That's never going to change. But those aren't sexy companies. The CEO's not on Instagram. The CEO's not trying to buy Twitter. They don't have any issues that people have in China. Just very boring deal. They're very boring drug dealers. Just make a lot of money. Right? They're just boring drug dealers. They just sit back in the cut and just keep selling that drug. And they keep making money because people are addicted to it. And nothing's going to change that. And that's one of the things I think people struggle with in this space is that they don't want to make money, right? They may be looking to get like emotionally satisfied, and that can be dangerous for them long term. So don't want to ramble. Didn't mean to make it this long, but if I was a long-term investor, this is how I would look at these scenarios. If you can incorporate any of this into what you're looking at, it could be beneficial to you. None of it's investment advice. I'm not a licensed financial advisor. I don't have the ability to finance you in the investment space. But what I do have the ability to do is to give you game around some of the psychological tricks that are being used in this area based on people who are been trained in this area, and also people who need these psychological tricks to go on for them to continue to maintain their business model. David W. Williams, also known as Diamond Dave. I'll talk to you later.